and pushing it down to even lower levels. And then very frequently there's overselling, and you get a bounce back up toward the original breakout point, or breakdown point in this case. And that's at least what we did see in these two instances. What I also did in that article, not as important, but kind of drew a symmetrical line across what then represented the potential tops of this, what could be, for technicians, a head and shoulders pattern, a shoulder here, a head higher here, another shoulder here, and so on. It might turn out to be that way. And I drew down here a rough neckline across what would be the neckline if that were, if that's what it turns out to be. The normal count when you do head and shoulders type things, well, you kind of count from the peak down to the neckline, and then you subtract that and say, well, that's a reasonable target. It's not a reasonable target in this case because it would be below zero. So not likely we're going to see something like that. But in any case, it is one of those classic patterns that lots of technicians like to look at and talk about. And the interesting thing is that as this has unfolded, when you start looking at some of the smaller, or let's say the enlarged pictures of the tops, there is a head and shoulders pattern in each of them. It's an interesting phenomenon, at least. Here you can go back to that other one in the book, and there you actually see a bit of a blow-up of the 2007 top and the current 2011 top. And in this instance, the patterns, this is something that's put out by Elliott Wave. They just did a study, and it just caught my attention. One of these things about analogs is that they're interesting, but they're not always terribly enlightening. But in any case, this is an interesting analog because they have really developed quite remarkably similarly. Now, every analog breaks down in the market. I mean, it's just a question of how long it lasts before it breaks down. And this one will break down too. We just don't know how long it'll last. But if you look over here, and I'll try and do this a little bit more with what I've got in my hand here, it's the same pattern to the top, here, here. Actually, there's a little zigzag down here, 1, 2, then up here and up here to the first peak. Very similar here and up to this peak. The time period across the tops is very similar, 21 weeks here, 20 weeks here. The time period from the peak over to what they call the end of the first wave is very similar, 23 weeks and 22 weeks and so on. They've drawn a line kind of across an earlier top and connecting bottoms, which looks to be on approximately the same angle in both instances. In the first instance, after you had the breakdown to what they consider the end of the first wave, which is, they've labeled 1 here and 1 over here, then you had the rally back up to this kind of rising trend line, and then the big fall away to the bottom of 08, 09. Here we've got a lot of similar stuff. We have not gone back to the trend line yet. In this case, to get to that trend line, we'd probably need another 4% rise or so to get back up into that same neighborhood. And obviously, we hope we don't see anything like we saw over here. So, as I say, every analog dies at a point. But as long as this one's continuing to run as consistently as it is, we're going to keep looking at it anyway and just see where it breaks finally. Let's turn now to the fundamentals, if you would. Over on the next page, there's a research piece I see regularly. I read a lot of stuff from ISI, which is a very good research operation in New York. And this one happens to be from their weekly summary, which came out yesterday. And just to describe the format here a little bit, what they list before they put 30 pages or so of analysis after it is just some headlines on good news and bad news, and then this is actually mixed news. If they put it on the middle line, it's supposed to be mixed news. And I just threw in my annotations and ask the question, are these news items balanced? And if you look down, and you can all read your details later if you have enough interest, but if you look over on the good news, you'll see a company info, Walmart, PepsiCo, SAP, 99-cent only stores, an acquisition here, a segment of the auto market here, Honda Motor, another individual company here. And I've circled some of the ones that would be somewhat more important because they have a broader application than a single company. September sales rose in the United States by 1.1%, beating expectations. Production, I can't read that really well there. Production in the 17-member Eurozone, better than expected 1.2% in August. And then Slovakia's vote to make the unanimous item in the 17-nation Eurozone. So a few international or at least national level things, and most of the good news is individual companies. They then put a few little mixed news in here. Policymakers say significant downside risks to economic growth from tighter fiscal policy and Europe's debt crisis, the Fed said. And then that's the negative part, that there's a real crisis here. But the positive part is maybe we're going to get some government rescue, additional monetary stimulus. Then you get down here to National Federation of Independent Business. Optimism index rose 0.8% to 88.9, up from a 13-month low, so it's an up, that's a positive, but still weak. As you'll see later, it's so weak, it's never been that low except in recessions. So this is the mixed news. And then over here, the bad news. I'm not even circling 10,000 jobs in New York, but then you look and see what is here. U.S. deficit hits 1.3 trillion. Spain, a whole country. You get the unemployment in Britain, whole country. Europe, whole continent. Brazil, whole country. The problem, J.P. Morgan here stoked new fears of the health of the nation's banking industry. So it's the U.S.'s banking industry here. And then I've connected the Japan machinery orders jump here with slowing global demand to hurt their export orders. So this is a whole multi-industry segment for them. This is a single industry over here. And then nearly 3 in 4 Japanese companies believe the economy will stall in the years ahead. Harrisburg, Pennsylvania declares bankruptcy, and so on. So to me, it's not that balanced. Here you got country and continent problems. Here you've got some good news out of individual companies. Not, if you were putting them on a scale, they don't come off and balance very well. So the news is tough right now. This is a very difficult economic environment we're in. And one of the big problems, as Susan intimated in her introduction, that we face right now is the lack of yield. But as she pointed out, there's yield available if you want to look at it. And we've got the 1-year Greek bond. She referred to the 2-year. I did her one better. I went to the 1-year where you can get 163% and a fraction. You just have to assume a little risk. That's all. And so, but I mean, what's the risk-adjusted return on that? I don't know what it's going to turn out to be, but it's an interesting question. And obviously, this is when you get risk, when you get numbers in this area, it's an acknowledgement of nearly certain default. And it's just a question of how long it's going to take, how orderly it might be. But nonetheless, it's a dangerous environment. Elsewhere, there's yield available at varying levels of risk. If you look to the 10-year sovereign bond yields in different countries, you've got Greece, first upper left-hand corner, that's 24.3%, and Portugal, just right of that, 11.9%. And the top two clearly cannot grow strongly enough to service this debt. I mean, those are numbers that have already gone beyond the capacity of the country to earn enough to pay it all back on a 10-year basis and then return all of the principal without somebody coming in and bailing them out. The bottom two, now we start getting to real players. The top two are small. The bottom two are very big. Italy is the third largest European economy, and Spain is the fourth largest European economy. So you're looking at two of the giants there, and the yields, while they're nowhere near in the same at the same level as Greece and Portugal and a couple of others that are among the pigs, these are very, very high levels, even though the European Central Bank has been aggressively buying these bonds in the open market. You can see where they peaked here and here just before the ECB went in and very aggressively bought those bonds. Now, even with that buying, you've started to see another spurt up, more in Italy than in Spain in this instance, but we don't know what the ECB is buying. They announce selectively. They have certainly said that they continue to buy the bonds of these two countries, but they don't say how much, and they don't say which ones on which days, and so on. In any case, you see Spain having risen to a 5.4% over here, and Italy having risen to a 5.9% over here. And as a rule of thumb, and I'm no expert on their finances by any means, but as a rule of thumb, the European commentators have been saying that if they get up around 6%, they get about to the area where they're not going to be able to service the debt. So we're obviously in fairly close range. Now, with today's rumor, I shouldn't say rumor, it's a report from The Guardian, not confirmed, then it will be interesting to see whether a lot of that money is going to be put behind as a guarantee for bonds like Spain's, Italy's, and of course the smaller, lesser members as well. We'll see. Much of Europe's economic success depends, as we've probably all heard in the news, on a strong Germany. And if you look at page 9, Germany's starting to weaken. And this is one of the, we've talked about, we're going to try and look at the possibility of recession. Europe is probably closer to recession than we are. Europe might be in recession. People aren't saying that with certainty, but they acknowledge that as a possibility. And when the real economic giant of the group is showing this kind of weakness, this is an ISI study again, as is this one, the German Economic Diffusion Index. What this is a collection of a significant number of important economic readings. And you can see that clearly it has come down precipitously into what ISI characterizes as recession territory. This is as low as it got in the 08-09 economic crash. So this is obviously getting down perilously close to those readings. And then from an expectations perspective, this just came out this morning there, ZEW. In October they were at a minus 48, which again you can see how low that is relative to this horrible economic environment we were in just a couple of years ago, and then how much below all of these others that go back into more than a decade. Page 10, your next page, shows how the market is increasingly worried about default risks because of the economic problems that perhaps those indicators may be pointing to. Here, what we're looking at is CDS, which is a credit default swap for each of these four countries, and it is a way to look at credit default swaps for those who don't deal in them or aren't that familiar with them is to think of it as kind of the cost of an insurance policy against a bond default in the 5-year time period, in that you can write them for different time periods. I happen to be showing you 5-year CDSs right now for these respective countries. And of course we know that Spain and Italy are in some economic turmoil and distress. And the most important thing is to see how significantly the cost of insurance on their bonds has risen just in the last few months, which is a way of looking at how much the market itself is evaluating the potential for a default at some point within that next 5-year time period. Also interesting to see, though at lower levels of price, is the same pattern, the concern for the second biggest